you have any money in shares right now, you might have noticed the markets slipping over the last couple of weeks. On Monday, the markets were down about 7% from their highs, and I've been having some challenging conversations with clients as a financial advisor. So let me tell you what I've been telling them. A lot of my clients have taken advantage of a dollar cost averaging strategy, which means that rather than investing a lump sum at the start of their investment journey, we've actually broken that down into bite-sized pieces so that they're contributing, say, every month over the set period of 3 to 6 months in order to reduce the potential risk in this exact scenario. But I've still been having clients reaching out to me and asking, should I stop my contributions? And ultimately, this comes down to your personal circumstances. If you're still able to meet your financial obligations, your cash flow, your capital requirements, then I don't see any reason why any of my clients need to stop these contributions. In fact, I think it would be counterintuitive with consideration to the strategy. See, the way that dollar cost averaging works is that as the market continues to go down and you continue to purchase in, you're reducing the average cost per share of your investments. What that means is that you're able to get a greater return over time by taking advantage of these market downturns. And if we're looking at a long-term strategy, that is going to accelerate your growth over time. It might feel a little bit uncomfortable, and everybody wants to invest when the market is hot and reaching new peaks. But if you always invest at the peak of the market, then you have to outperform those certain benchmarks in order to get any uplift on your investment. And that's not always going to happen. But if we invest at the bottom of the market or as the market's coming down, we can potentially get greater uplift on our investments over time if we're in a position where we're able to hold on to those investments for the long term and wait for a market recovery. And to give you a bit of an indication on what that might look like, when we see a 10% to 20% correction in the market, those have on average recovered within an 8-month period, which in the grand scheme of things is not very long. Again, this comes down to managing capital and cash flow requirements and ultimately personalized to your circumstances. If you're still feeling a little bit unsure, I'd be happy to jump on a call with you to explain in further detail. So shoot me a DM or click the link in my bio to book a call with me.